What do billion-dollar donors and business buyers really want?
It's not your numbers.
It's not your plan.
It's something else.
And today's guest knows what it is.
I'm Bo Barron, CCIM.
I'm Timmy Barron, ADHD, and this is Commercially Speaking.
8, 7, 6, 5, 4, 3, 2, 1.
Today's guest once helped raise over $5 billion. $5 billion with a B.
He served as Associate Vice President of Principal Gifts and Strategy and was the Executive Director of Notre Dame's capital campaign.
Pause. To put $5 billion into perspective, the total production budget for the 22 Marvel Cinematic Universe films, everything from Iron Man in 2008 to Avengers Endgame in 2019, is estimated to exceed $4 billion. That's $1 billion less than over $5 billion.
It was the first higher education campaign in history to break $5 billion without a med school.
Do you know how hard it is to raise money without saying, help the children, or we're going to cure this disease? It's like winning the Daytona 500 in a golf cart.
Now he's the Chief Operating Officer of Sator Grove Holdings, a permanent capital investment firm partnering with founders for the long haul.
They don't sell, they don't flip, they adopt, like Angelina Jolie, but for HVAC companies.
Today, we're getting into what permanent capital really means, what he learned raising billions, and what founders should know before taking on a partner.
Also, I'm going to pitch him my new startup. It's a biodegradable chia seed pouch that whispers affirmations as it dissolves.
You can't keep doing that.
It's pre-seed. See what I did there? See?
Please welcome to the show.
The COO of an investment firm that holds on to businesses like your grandma holds on to Tupperware lids.
A man who could convince a brick wall to open a donor-advised fund.
And has raised more capital than 242,955 Monopoly boards. I did the math. Put your hands together for Greg Dugard. Hey!
Thank you, gentlemen. I could have listened to that intro all day.
You got it.
I thought I was going to have to.
A little long. Okay, let's take some notes. I was sharing with you before we started kind of how I met him in a sauna.
Yeah.
And so something special happens when you meet a guy with your shirt off, but that's not the first time.
And we were doing cold plunges too.
That's right, cold plunges
that as well. We're not one-trick
all
ponies.
that frou-frou stuff, which I enjoyed, frankly. I'd never done a cold plunge before.
Oh, it's great.
It was
epic.
More manageable than I thought.
Oh,
But
yeah.
They weren't that cold.
I tried to meet you before. Did I tell you this?
No.
So we're at this capital camp, me and Brad Arns.
Yeah.
And we listen to them on this panel, him and his partners. And then we come out of the elevator, and there he is. And he's talking to one of his partners. And we go around the corner, we notice, and we already knew we wanted to talk to him.
Right.
And so we go around the corner, and we look at each other, and let's go back. So we go back, but they're having a conversation. It's a meaningful conversation. They're not shooting the breeze. You can tell and so I position myself at about a 30-degree angle off his left eye.
Yeah.
And I'm standing there, and Brad's next to me, and nothing. And I stand there for about 30 seconds, and I mean nothing. And I look at him, I look at Brad, and Brad looks at me, and we're like, all right, let's get out of here. And we walk around the corner again, and I said to Brad, I was like, man, most of these conferences I go to, a lot because of this podcast, like I'm a fairly well-known guy.
Right.
And I've never been just blanked like that before. It's like, it was a realization of how we were absolutely nobodies in the capital camp. And then we end up in this sauna, and there he is with his shirt off, and I've got my shirt off too. And I'm pretty sure
we're all taking our shirts off. Come on.
And I'm pretty sure that's him, but disrobed.
Never seen the nipples before.
I didn't know. And so somebody brought up Owensboro, and he goes, "Oh, you're from Owensboro?"
Yeah.
And I'm like, "This is what got your attention?" I was like, I was like, you know Owensboro? And he's like, my college roommate is from Owensboro.
Oh, wow.
Which is a guy named Mike Edge, who I know.
Wow.
I've known the Edges for years and years.
Mary Catherine brought up the Edges, right? Is that a different Edge?
No, it's probably the same. They've
There's
got all
only
those
one
brothers.
There's only one
there's
edge.
a lot of
There's a ton of brothers.
So do you want me to make you feel better about that interaction that we didn't have when you were trying to have one?
Sure.
Yeah.
So I'd like to say
I'm over it, but I'd love to hear.
It doesn't really sound like he's over it.
No.
He just put it out for thousands and thousands of people to,
And I had to sit here and
empathize
I had to act like it was the first time I've heard it too. So.
Or that you're interested. Yeah.
So I'd like to say that I was
story.
like super dialed in and focused on that conversation, which probably was, but there have been, and you brought up that, you're kind of well known, and this is a true story, and it drives my daughters nuts to this day. I don't know how many years ago this was, maybe 10-ish, 15 years ago, whatever. And I used to, game days, football game days at Notre Dame were work days for me, raising money and all of my colleagues in development. Those were hard weekends. They're fun, but they were hard, long weekends. And often I was wearing a suit to the football games, and I happened to have a suit on one day, and I had a green tie on. I happened to remember something I had to speak at in the morning, and then I watched the game on the sideline, and normal day. And in the old Notre Dame Stadium, you couldn't get cell service until you left the game because you had 110,000 people trying to use the cell at the same time. The data coverage is awful. All right, so I'm not getting messages, right? I leave the game, go home. It was an afternoon game. I had to go home and change to do something, go to some other event, and on the way home, like my phone, I start to get data, and my phone starts pinging, text, voicemails, blah, blah, blah. I'm not thinking anything of it. I'm driving, I'm not texting. So I get home, we only live a mile due south of campus. Go inside, and one of my daughters comes up to me and says, "Dad, you didn't tell me who you were taking to the game today." And I said, "What do you mean I didn't tell?" Like, I wouldn't tell her who I was taking. She was, I don't know, probably 10 at the time. I wouldn't have said, "Oh, I'm going to take John Doe to the game today. I'm asking him for a gift." I wouldn't say that. And she's like, "I can't believe it. You've offered to take us to games, and you didn't take us today." I'm like, "What are you talking about?" I'm like looking down at my phone, and they're like, "Dugard, did you have a green tie on today? Did you see the cameras?" I'm like, "What are these people talking about?" And then the news happened to be on. Apparently, I took Taylor Swift to the football game and had no idea she was standing next to me.
Holy shit!
For 4 hours.
Well, so I feel much better.
Bad, my friend.
I feel so much better.
I'm like, she had sunglasses on. I didn't know who it was. And then she had some other, I can't even remember her name. There's another, like, some star with her. Her brother went to Notre Dame at the time. He was a freshman. And really the only place that she could be in the stadium was on the field, so people couldn't get to her.
Sure.
And then she probably found, the safest place on the field was some knucklehead next to her that wasn't even looking. They had no idea who she was. And it's like, I probably would have recognized her if I looked at her.
Oh, man.
Wow, but, that's crazy.
Yeah. So you're like the second most famous person that I ignored, apparently.
Right? Or the least famous would probably be more. But I like how you framed that. Yeah. That was good. Our grandfather was a huge Notre Dame fan.
Oh, yeah.
I love your grandfather.
So I grew up watching Notre Dame games with him on Saturdays, and he was the guy who, like, you couldn't get up and cross. Until commercials.
Yeah.
Like it would, no. Like you sat there until commercials. Like you did not cross the TV while the game was going on. It was serious. But he got to be in the crowd when they filmed Rudy.
Oh, nice. Yeah.
So he was.
Yeah. Oh, that's awesome.
That
Yeah,
that's fun. Up there. That was, they filmed it over it was right before I went to law school there, the year before. And I went to a couple of the games, and there were some fun ones. Like it was like one of the snow games. So the snow seed was actually snowy, and it was awesome. It was against Boston College, and Notre Dame killed him. It was great. It was a ton of fun. Ton of fun. So the Rudy thing was a lot of fun on campus.
Oh man,
that's awesome.
When that was going on for sure.
That's cool.
For sure.
Well, so let me ask you this, because you were a lawyer, right? You were a lawyer, then you went into M&A.
That's right.
Which is merger and acquisition.
Yeah.
Nice. Yeah. Thank you very much. And then went to Notre Dame, and now you're at the newest venture here.
Right.
I'd love like a 5-minute little origin story to understand you a little bit more and where you got here. So you don't have to go like deep into it, but like the pivots, the little turns that you've made that have made you who you are now.
Yeah, I think it's been looking back, it makes a lot more sense than it did at the time.
Sure.
Right? I mean, my wife says, and I've got this amazing wife who's super talented and like can read people like that and has, the heart as big as the globe. And she said at one point to me, it's amazing when you look back at your experiences that you've created or you've gathered all these skills that are perfect for the position today. Right. But I wasn't doing it on purpose necessarily. I was thinking about, I tell my kids all the time, or like, students that we mentor or whatever, that be open to things. Right. And when they come, and generally your gut is right if it's time to do something else. And practicing law was a lot of fun because I got to learn a lot. It was a weird business, weird business. I mean, you're just selling your time, right? And generally you're selling it to make someone else a lot wealthier in the corner office, which is fine by me. Like I think I've served my entire life as someone who tries to generate a heck of a lot more value than I capture, right? So I didn't have a difficult time with that. What I had a difficult time with, what they wanted you to do is look at the person in the corner office and say, we want you to be that person. We want you to want to be that person, right? And that's why you stick around. So at some point I figured out that, I was learning a lot. They let me do a ton. It was a great firm. I had a lot of good mentors there that were very meaningful to me. But I had several that say, you're crazy, when I told them I was leaving, which is funny. Like every time I've taken a different role, someone has come to me and says, oh, that's the wrong thing to do. It's the wrong thing to do. So I bring that up for a particular reason, because I'll circle back to in a minute. And then I went into Honeywell. It was a Fortune 50 company. It was this amazing opportunity. I got to go into a manufacturing business. Like, I'm a builder at heart. I love to build, right? And it was manufacturing business, and we were doing aircraft wheels and brakes at the South Bend location. It was so fun. And then we kind of had a big business reorg, and then I had a different job, which was like another amazing job where I got to fly over the world and look at technologies to buy for Honeywell. It was a ton of fun.
Wow.
But I was traveling a lot.
Yeah.
So I got to really learn how to interact with C-suite level people and understand like how technologies can drive businesses. And then probably the most important thing that I got in that time was, how do I deal with people that are just everyday people in different jobs? Like when I was a lawyer, everybody I managed and any team I ever had there, everybody was running through the wall. Like we didn't hire people that wouldn't work 24 hours a day.
Yeah.
And they all wanted to succeed, and they all wanted to learn, and they all wanted blah, blah, blah. It wasn't the same way when I got to, into a company. Like you had all kinds of different people. You had some people like that, and you had some people like, nope, I'm here for my 6.5 hours and I'm gone. Right.
Yeah.
And so all kinds of different things. So cool opportunity there. And then going back to my alma mater was just by accident. I was going to teach a public M&A course there with the then dean of the law school, close friend of mine, Patty O'Hara, was this amazing jurist, amazing faculty member, amazing dean at the law school, and the one, by the way, who is responsible for bringing Amy Coney Barrett back to Notre Dame Law School is Patty O'Hara.
Oh.
And she asked me to help her with this class, and then I took a different job when I was like, I can't do it. I'm going to be traveling all the time, blah, blah, blah. And then she is the one who actually said, well, you'd be great in development in Notre Dame if you ever want to do something different. And I didn't know what development was, seriously.
What is it?
It's like just fundraising. Nothing
wow.
else.
Oh, okay.
Fundraising.
Yeah.
But I didn't really, just wasn't aware of it, as naive or whatever. And I met with some of the team there, and a few years later ended up coming on board to Notre Dame, and did a bunch of different roles and positions. But every single stop, they allowed me to be super entrepreneurial. Which was really fun.
Yeah.
And I was lucky because I don't think everybody has that same experience at those. And I can remember when I was interviewing with the top person in development, who is now a close friend of mine, taught me, the right way to be a servant, servant leader in an organization, and gave me this amazing opportunity to serve, right? Is a guy by the name of Lunani, best in the business in terms of fundraiser, best fundraiser I ever met in my life. But I remember asking him, he said something that, probably make your skin crawl a little bit. And we were in the back of a church at our local parish, and he said, you better be able to walk on water better than Jesus if I'm going to hire you. That was his mentality. Like, I got to hire somebody that's unbelievable, amazing, whatever. And I told him, I said, well, I don't know if I could do that, but you better let me be as entrepreneurial as I can be. And he said, deal, done. Right. And so like, I have an entrepreneurial spirit, and when I had the opportunity to help two close friends who worked at Notre Dame with me in a different area, they worked in the investment office at Notre Dame, both, amazing investors, had a great run at Notre Dame. One was 15-ish years there, one 12-ish years there. They were probably managing $15 billion of public equity at the time.
Damn.
And they had they faced a pivot in their lives where the longtime CIO of Notre Dame, Scott Malpass, kind of legendary figure in the endowment world, decided to retire. they decided it was time for them to move on too, and they knew that they wanted to do something together and form something different, and not different for different sake, but taking all the learnings that they had gathered over the course of their careers, and which I shared, some with you guys earlier, and tried to, think about how do we do this better? How do we start an investment company that is going to be different than what's out there today, and allows us to serve not only founders but our partners, right? And then ultimately serve good by doing so. And so I was a day one shareholder, and then kind of I'd say a close confidant of them when they were launching and going out on their own, and then I joined shortly thereafter. But every single time someone told me, "Nah, this isn't the right thing to do. You shouldn't do that."
Really?
Every single time. I just had a conversation with my nephew, one of my nephews. He was thinking about changing a job, and I said, what I've learned? If somebody like senior at one of these companies says it's not the right thing to do, that's probably your tell.
Yeah.
It's the right thing to do. And I have all these people. It's so funny. I have all these people come to me and ask me because of these different goofy experiences, whatever they've had, and they'll say, ask for career advice or things like that. And I'll go through this long. Well, this is what you should think about. This is what you should think about. And then I always close with, but don't listen to me. Like, I don't really know. You don't really know. Timmy might know, but no one really knows. Like right. The person and the opportunity and where they are in their own, maturation process and things. So. Like it was a big learning for me that I had all these great pivots that were just these amazing opportunities, but not everybody expects. And then this was certainly no linear path to where I am now.
Sure.
But it gives me this pretty cool background and experience that I can pull from that. I'll sit on boards now of our companies that we deal with. We don't really have a technical investor relation role, but certainly with my time and working with very ultra high net worth individuals or families, just communicating with them and playing an investor relation role with them. Or when it comes time to fundraise, we don't really fundraise, but if we did, or when we're going out and trying to talk to some of our founders and things. One other quick little anecdote to that story about us walking. Mm-hmm. When I was with my partner in the hotel, all of our meetings are walking. Mm-hmm. So when you said that it was not just a catch up, whatever, like it probably was literally a meeting.
Yeah,
it looked like one.
We don't meet in an office. We literally will drop our bags in our office and then we walk.
Yeah. Well, it's good that you're in Florida then.
It helps to be in Florida where you can walk 12 months of the year. It does.
Nobody's walking outside.
Nope. It would be a little bit harder. But so it truly was probably a meeting that we were having.
And I had a version of this, what you're describing, that conversation with my son today. He's 23.
Yeah.
He's at Enterprise, and one of his classmates cold called me today. Yeah. Just walked in, commercial insurance. And, don't I love talking insurance? And I told the kid, I was like, hey, look, one of my biggest investors in our deals is my insurance agent. And so I don't want to waste your time. Like my business is his. I appreciate it. So he's asking me about my son and maybe reach out to him because they could use some help. And so I was letting my son know, hey, this guy might be calling. And he's like, would I have to move? I was like, hey, look, I don't know. But, man, talk to the guy. Like, see what your options are.
Yeah.
See what kind of opportunities are out there. Listen to your gut a little bit. Weigh your options. Make a call. Because I've had a lot of pivots in my career as well. I've done food safety and a lot of commercial real estate, different things in commercial real estate. And every one of those things have created a breadth of experience that serves me well now, which is what I just heard you communicate.
Absolutely.
And
totally right.
It's valuable. Even if you went left and you probably should have gone right.
Yeah.
There's a tremendous amount of learning and value in that that's going to serve you well later on.
Yeah.
I mean, it's no different than investing. I mean, what you probably think in your deals, you probably remember the bad deals more clearly than the good ones.
Very true. Yeah.
And the learnars.
Yeah.
If you're going to do it for a long time, right? And that's the business that we're in now is trying to be, a very long time horizon person and be something that's durable, right? You got to learn from those mistakes for sure.
Let's pivot to that a little bit because the reason I wanted to have you on and talk about this is because what you guys are doing at Sator Grove is so different than what we see in commercial real estate, where you have 5-year deal cycles, maybe 7, and you buy something to build it up and sell it. You take your winnings off the table, and then you go do something else with it. And when I heard you guys talk on the panel, what you were talking about is, you could do that with a company. And I think normal is you invest in a company and then at a certain amount of time later, you're almost forced to sell because that's what you told your investors. You got to return their capital to them. And you could leave a tremendous amount of wealth and growth on the table by exiting too soon. And what I heard you guys talk about was the permanence of your investing time. And that word permanent really gave me a little bit of heartburn. I was like, what are they talking about? You don't see that in commercial real estate. And now I've noticed it a few places. Now that the concept and in our company, Hearthstone Capital, like our third fund that we're about to launch is based off the model that I heard from you guys. Like we're doing an evergreen fund and it's different. We're having to think through all the things that it's different, but give me why did you guys do it that way?
First of all, it's not only different, I would say, than what you see in commercial real estate world. It's different from investing writ large, I would say.
Yeah.
If you look at, it's become in the last 25, 30 years, like these alternative asset classes, whether they're private equity or venture or hedge funds, generally they're all, constrained by time. And time should be the easiest component to dictate. And why would you artificially cut off something that's just beginning to grow? It doesn't make sense fundamentally. So, but why do we do it? The real answer is Rick and Paul, my partners who travel around the world meeting what we would consider to be world-class investors in different asset classes, different geographies, different structures. And almost always you came back to time horizon was an issue, right? There was such a destruction of value because you had to sell at a certain time.
Do you have an example off the top of your head, like to just make it more concrete?
I'd almost flip that and say, name a private equity investment in the last 25 years that you've heard of that has done something other than destroy value. They all sell to each other, like these private equity firms. But there are some easy ones. I don't know. I won't know the numbers right off the top of my head. But if you look at, you could Google quickly the Sequoia selling Apple too early. Like that would be worth, 100x, 200x, 500x, whatever it is now. And they're fund issues. But at the time, was Sequoia wrong? Oh, I don't know.
Right.
It was a home run when they did it.
It was a home run, but now it would have been,
bunt.
Yeah, right.
Twitch too. The guy who sold Twitch. Do you know that story? Yeah.
Yeah.
Like it was so low.
Yeah. No, there's a lot of stories. It's not just venture, and it's not just Sequoia. Sequoia has an unbelievable track record. By the way, you would take Sequoia's track record over the last 20 years. People like Warren Buffett and a guy who's very close to Sator Grove, Mitch Rales, always they talk about durability and long-term horizons. And to make something great, you need to have a long-term horizon. Greatness doesn't come overnight. Almost in anything, like you name it, and it doesn't come overnight, right? People think about, if I asked you guys right now, what publicly traded stock accreted the most value over the last 30 years? What would you guess?
NVIDIA?
No. I mean, if over the last 2 years, probably, but
right. No, my mind goes right to things that are more recent.
Well, I probably would guess Apple.
Yeah. So Apple's up there.
Microsoft, maybe.
Yeah, that's a good guess.
The NASDAQ.
These would be companies on the NASDAQ.
Right.
Alphabet?
Well, I just gave you one freaking name, and you can't even repeat
Sequoia.
it. No,
well, Berkshire Hathaway.
Right. Oh, yeah.
So most people would guess like Berkshire, Apple, Microsoft. Sure. The real answer is Microsoft. But up until 2 years ago, it was Danaher. You guys know what Danaher is?
Nope.
So Danaher is now that it's the second greatest publicly traded stock story in the last 30 years, and it was founded by Mitch Rales and his brother Steve Rales, and they started as an aluminum siding company, and they had the Jake brake from trucks that they had, and they've made like 4 major pivots over that period of time that they've been publicly traded, and today it's one of the largest life sciences, if not the largest life sciences company in the world. And so that's the Mitch Rales that I talked about, that, he talks about greatness does not come overnight. It's, over a period of time, and then use compounding to your advantage, right? And that's
Well,
Warren
that's what
Buffett
you
and-
take off the table when you have these short time horizons.
That's
is
right.
that power of
the
compounding.
power of compounding, that opportunity to compound.
And not to, I feel so rude doing this.
Yeah,
my
you're good.
wife is stuck
Oh, she's stuck? Where is she?
in my driveway.
Oh, she's stuck in the driveway. Oh, gotcha. I see. Yeah.
I ignored her call, and then
Coming in or coming out?
I think going back.
All right.
But in my daughter's car.
Well, why is it that so many companies do this where they've got a timeline? Do you know why?
It's a great question. It's a really good question. I think it's to provide liquidity for general partners. Typically, the general partners are the ones who run these limited partnerships, right?
Right.
And the general partners need liquidity or want liquidity because they're partners and they have all of their wealth tied up in these things. And then you have institutional partners. Generally, your standard investor in a large, like in a Sequoia or a Blackstone or somebody, are institutional investors. So these big institutions could be college endowments, could be sovereign funds, could be pension funds, could be things like that would be institutional, right? And they over time want some liquidity too. So your investor is demanding it a bit, and then the management wants it. So it's like the perfect storm of
Sure.
Okay, let's do it.
Now-
What else happens though? You're generating fees, like the management is generating fees over and over and over, and then they go out, and it's a cycle, right? I mean, it's no different than in the CRE world, right? That you're going to raise one fund, and then once you are can invest in that one fund, you go out to your next fund, and you want a track record. And to show a track record, you got to have some realizations.
Right.
Your realizations, you got to sell some things, right? And you're going to sell the winners, you're not going to sell the losers because you're trying to prove a track record for the next fundraise. And then you go through this whole cycle again. It becomes this kind of vicious cycle.
I see.
Over and over and over. And it doesn't have to be that way. And it causes there's other disruption. There's, that mentality is a disruptor on many different levels. It causes friction between the investor and the founder, potentially founder and customer, potentially founder and other employees, certainly employees in a private equity fund. And that's why you see a lot of churn in the investment world. John Doe going to a different company and Jane Smith going to a different company and not having a lot of longevity, right? And then to the ultimate customer, the investor, right, you're worse off potentially. Like if you look back and think, if I just held on to it, because what do those institutions do when they ask for liquidity? They don't really do much with it. They redeploy it.
Right.
They go back into your fund. Like how many investors in the CRE funds are repeat investors?
Oh yeah,
Right.
At
All of
least
them.
half.
Yeah.
Or like in my
you,
deals,
if you
like
do well, they're going to come back. So they're just recirculating the capital. And what happens when you distribute money to them? What do they pay?
You get fees.
oh,
and
they
some
got
taxes.
cap gains. And,
Cap gain taxes. Like
yeah.
it's so inefficient,
Right.
Well,
but
here's the thing though. When I sell the deal
Yeah.
to these investors, I'm framing it. The whole thing is to think about one number. And for us, it's IRR.
Yep.
Your internal rate of return. How hard is your money working for you while it's in this deal? And to give them the number I promised, I have to sell.
Right.
There has to be the reversion at the end. From the jump, it's totally expected.
and everybody's conditioned for that.
That's my
Everybody's
point.
conditioned,
And
yeah.
so you're factoring in all the inefficiencies. Like you're going to have to pay the tax. Like when this happens, you're going to have to pay the tax. And I'm not going to give you after tax numbers because I don't know your tax situation and I'm not a CPA. So I'm just going to give you your pre-tax numbers because those numbers look better anyway. And you spend the whole thing, like the whole pitch is baked, like all those efficiencies are baked in, like that's just the way it is.
That's how it is.
Yeah.
Yeah.
And so when I listened to you guys, I was like, and you just said it, it doesn't have to be that way.
Yeah.
So tell us how it can be.
Well, everything we think about is a MoIC, so the multiple on invested capital, not IRR. We don't calculate an IRR literally.
MoIC?
None. Yeah.
What was that?
MoIC. So we the funny thing is, so the people that are attracted to a structure like ours are generally individuals and families. So that's the path. Is one thing. If we wanted to raise $10 billion, it would be harder to do it without taking institutional capital. We didn't take a penny of institutional capital. We only want principals, right? We only want principals. We don't want agents, and we've kept to that for the most part. And generally, and for us, the three of us, it's all of our capital for our investors, our shareholders, it's generally a fraction of their net worth. So they can afford to not have distributions on a regularly scheduled basis. And they can afford to be in for the long term. Now, we say permanent, we say long term. We will absolutely make distributions at some point when we have realizations. We're not now. We just crossed 5-year mark. We're not doing it now. Like, we're just getting to flywheel stage, and we're not going to take money off the table. Even if we got a realization, we probably wouldn't give back capital right now, because we have a lot of opportunities in front of us that we can do that we think will meet our standard, right? That we want, to compound over the long term. So individual families are a lot more receptive to this permanent nuance to a vehicle. Funny, when we just had a conversation with a group that is interested in investing in us, and we're not taking money. We don't fundraise. And
do you miss it?
It's weird, right? Like, because
it's so weird.
Everybody thinks that I don't miss it for one reason. I'll tell you why. But everybody thinks, oh gosh, you just spent 17 years of your life fundraising, and
you're good
now,
at it,
and you're going now to a company that's great, and you're going to be fundraising all the time, because that's what private equity does,
right?
But that's not what we are. We basically, I don't even have a sales deck. Like, I have nothing. People that have come to us and asked to invest, if we're comfortable with them, and we typically only do business with people we, have a number one great working relationship with, admire, we respect, that we want to spend time with, and they have the same philosophy that we do. The love wins, and if they don't fit that, and they're just not right for us, and we're not right for them either. So I don't miss it. I miss a lot of the people that I got to,
sure,
that I became so close with, because fundraising it's an odd profession, because the better you are, the closer you get to people. So it's like me asking a brother, would you be willing to consider, a gift to do X, Y, or Z, right? And they don't have to do that, right? It's going to be out of their goodness of their heart, or for whatever motivation they have. And if I know that person isn't going to give, I can't be friends with them anymore. In that relation, in the work relationship, you know what I mean? It's just weird. So every time I'm with somebody, when I'm wearing my fundraising hat, I'd always have to be thinking, well, what's the next thing? What are we going to talk about next? And, I always kind of have to, this is my job, right?
Right.
And so I don't miss that at all.
Yeah.
Because you just got so close. And there's these amazing people, like not only amazingly generous, but like just so cool people that are super interesting, that are really thoughtful, that are doing amazing things out in the world. It's refreshing not having to think about, well, what can I get out of this person?
That's right. I mean? Yeah.
Tough. It's tough. I don't mean it to sound like it's a big burden, because I wasn't doing it for me.
Right.
I wasn't asking people, and I didn't like, whether I raised $1 billion or $1, I got paid the same thing basically. So it's not like I was in the private equity world raising, $1 billion and getting a cut of it. Right.
But it's always there. Right.
Totally. Always there. And that was hard. Right. Yeah. But I always believed in the mission. Like, I've only raised real money for one place, and it was the University of Notre Dame, a place that I believed in the mission and was helping a ton of like people do great things, with that. So it was not like I was asking them, hey, can you give me money so I can get a new car? It was like, I want you to, we're trying to end poverty here. Right. And through Leo, this amazing thing going on at Notre Dame right now. And so that was easy. Like, the asking was simple. Yeah, that wasn't the issue. It was all, but the thing that was always in the back of your head is like, I always got to be thinking about it, talking about it. So long answer to your short question there.
Yeah, sure.
But on the permanent side, so we had this conversation, and it's kind of a right brain, left brain type thing, right? And like the lawyers and the accountants and the people that are in charge of a trust or something, all they're thinking about is, how can I get the money out? Whereas the other side of the brain is thinking, what you're worried about is exactly why we're going to make more money.
Yeah.
Because you're worried about getting the money out, and they're telling you don't have a right to get it out. And that is what's going to help us compound dollars. So some significant investors in Sator Grove, they loved it, because what they thought was, well, this is amazing, because let's say John Doe wanted some capital back, but Jane Smith didn't. John Doe couldn't demand money at a time. And generally, when do people want money back?
Yeah, when it's bad.
When it's bad, right? Which is detrimental to the partnership and detrimental to the business, and like forcing your hands in a really, really bad way. We'd rather be buying. Like, look at what Warren Buffett does in the downtime. He's buying generally, not always.
Sure.
So like, people love that protection, because they think, well, some LP that just has some liquidity needs or think they have liquidity needs, even worse, and try to disrupt, selling assets at a time that you shouldn't be selling assets, that you should be holding or doubling down on them. So like people that are long-term thinkers, that's how you compound. That's the Warren Buffett. That's how you compound. You do not sell in down markets, right? And it's this amazing tool that if you can leverage it appropriately, that good things can happen. And by the way, we're agnostic on industry. Like we can be long, we can be short, we can be equity, we can be debt, we can be industry specific, we can be industry agnostic. It doesn't matter. Like what we're trying to do is find great people and then surround ourselves with people. And a key for us, if we're going to have a permanence to our structure, which we do, what's really key for us is how do we find founders that are doing something or want to do something that's their life work. Like we don't want to go into a private equity fund that's going to sell in 5 years. Like that's not where we're at. So we need to find people who are going to do their life's work, right? That are these amazing, could be young, could be old, whatever. But people that have some talents, that have some following, have some amazing skill set that we think will be long-term compounders. It's not always easy to find them, but it's weird. Like the ecosystem is small, like in these permanent capital worlds, and the founders find you sometimes because we think there's an inherent advantage when we're out talking to a founder, right? And they're considering A and B, a bucket of money, I can bring it or somebody else can bring it. And if I don't have a time horizon and I'm really long-term focused, they're generally going to gravitate towards us. We found that to be true. That wasn't the whole reason we did it. And then as it boils down to back to your question of why we did it, Bo, it was what we wanted for our money. Like we just felt that was the best way to compound over long-term. And we're all pretty simple. I mean, we work for a nonprofit I worked for a nonprofit for 17 years, one for 15 years, one for 12 years. It's not like we had these lifestyles that demanded that we get distributions every quarter or that we have a huge percentage of the capital raise. So whether we raised $1 billion or $1 million, we just have salaries. We got paid the exact same amount of money. We can earn shares in the company over time if we beat our hurdle, but it's not, but they're not paying us cash to do it. They're not paying us a fee every year to do it. It's a budget that we set up, and people really like that too, because in theory, we're just shy of $1 billion right now. And at $1 billion, our budget base, should be 30, 40 bips, in terms of fees.
You got bips?
What is a bip?
Basis points.
So
like 0.3% would be, is that 0.3 or 0.03?
0.03.
0.03.
Yeah.
Okay.
Private equity would be 0.3. That's the difference.
Oh yeah.
It's usually a 2 and 20 firm, right?
Slow down here because our podcast works because Timmy sits in for the audience.
Yeah.
and a lot of the jargon of this kind of thing. One is we're a little bit outside of commercial real estate, so I'm having to think a little bit more than normal. But bips, when he says 30 bips, they're just shy of $1 billion. Basically, their overhead or the expense of the fund is about 30 bips or 0.03%. So all that $1 billion that's been invested in Sator and deployed into these companies, what they're taking out of it in salaries and their expense budget and that kind of thing is about 0.03% of the pie. Normal private equity might be more like 0.3%.
Oh.
Or, 10 times more on the overhead side. So they've got a much more efficient model.
300 bips.
For the investor.
Huge economies of scale. Huge. There's 3 of us. We outsource everything. Almost everything. And because we're not churning investments, I don't have to have a team that's constantly selling things, right?
This sounds so nice.
We don't.
This sounds so nice.
Doesn't mean we don't have challenges in those companies that we own.
Of course.
But what we do is, but truth be told, like it is a nicer way to do it. Like there's some, you're spot on that. We one of my partners always says, we want to have a radical integration of our lives, not only together, but our families and things, and like how like I told, we walk for meetings, right? I mean, that's part of it. Like that's something we want to have action, and then we want to have contemplation, both, and they need to be married with one another. And how we do that is very different than like all of our old lives and what we used to do, whether it was in the corporate world or there in a kind of formal institutional investing world. You wouldn't see that somewhere. Like when we have founders to our office, we don't sit down on the table. We literally will go walk.
Yeah.
And that's how we get to know people.
Right.
And
I love it.
We're just, the canvas that we're painting on happens to be, inequities and a lot of in software and things, but it's no different than if you're doing real estate and, or if someone is doing something else. It's, you're still making a bet on the people. And we think the best way to know these people is to do things that are, just like you would develop any relationship.
Sure.
Like if you want to develop a relationship, if you're telling your son or daughter to, develop a relationship, you're not going to say, put a suit on and go in front of a table or a desk here and debate over something over this desk.
Pull out that pitch deck.
That's right.
Looked at, just scroll on LinkedIn for 5 hours. That's not how it works. It's not at all. So it is a nicer way, but and then we're not afraid in our position paper that the guys worked on before they launched. So it's pre-me. We had a bunch of reasons that said
they did it wrong.
No. It was
okay.
great. It was great.
It was great. I read it.
It was great. And they had a bunch of reasons that why Sator Grove might not be for you. It was kind of like trying to put your arm around like, okay, we're not the traditional investment firm. We may be we're not trying to have a diversified asset allocation, right? We may be very concentrated. I think in the first memo that went out, I think they said that a handful of positions could be up to 30% of our assets. Today, like I think two of them are over, two together are over 50% of our assets. So it's even more aggregated than we predicted upon at launch. And we feel even better about it.
Yeah.
Right. I mean, it's like, we wish we could maybe even be a little bit more concentrated, to be honest. Yeah. Whereas like institutional investors think, whoa, wait a minute, and
diversification.
We need some diversification. Well, why? Just diversification for diversification's sake doesn't typically lead to greater returns over time, and it really doesn't lead to a diversification of risk, even though people think it does. You could come up with situations or hypotheticals, that it reduces risk, but not, diversification just by diversification does not diversify risk necessarily.
Yeah. Wow. Dad was never very diverse with where he put his money.
Not at all.
Not at all.
He invested in the things he knew and and understood.
Yeah.
And he went all in with it.
That's right. Yeah.
Yeah.
All in. That's another misconception, right? And so Mitch Rails, we've mentioned, he has this great line that he would say when we were launching, he made the analogy of, you're using guns right now and taking shots at things. And then when you figure out what's the right target, that's when you bring the cannon out and then go all in. That's a lot of what we have done is deploy capital in the last few years in companies that we think are the long-term winners. So we keep doubling down and going all in on some opportunities. So that's a way. I can't remember the number that he says, but Warren Buffett, has said numerous times that he's only made 6 or 8 great investments in his life, right? And you just keep on. A, you hold them, and then B, you keep on investing in those.
How do you determine a long-term winner? Or you're still learning. I guess it's not one answer for everything, but what are some qualities? Because it's in the person, right?
Yeah, it's a great question. It's an awesome question.
I'd be interested in the inverse to that question as well. Like, what makes you want to run for the hills?
Sometimes people, you can
vibes.
Yeah, some of it, like how they start operating differently, and short-termisms can get into people's thought process and decisions they make, and that's typically when you smell that, or you have a founder coming to you. We haven't had this particular situation, but in old past lives, a founder that was all in, and founders can be tricky. Like these people who are inventors, like entrepreneurs, they don't typically stay in the same business for a long time. Like that's not how they're wired. They're wired to start stuff and get it to point A, not to point D, you know, and so it's just hard for them. But once you have founders that, you know, are getting a little bit antsy sometimes, then you think, maybe it's time. And sometimes the technology just doesn't work, you know, that you make the wrong bet.
Yeah.
That and the market will tell you, you know, in that situation, like if it's not being absorbed or adopted or it's not selling itself, you know, these software companies that we talked about before, the ones that do really well, like the product sells itself. And you don't have to have a ton of salespeople calling. You know,
that's right. It's mostly in tech, you said.
Totally, yeah. And you get, the market will tell you, you know, when something is, you should run from something, and then you have hard decisions because you might have great people and you may have had a great process, and you know, you just have to make the decision. Now we're not going to deploy more capital towards that. And then of course you want people that are working on things that are just like these edifying projects. And if you start sniffing out that they're not, you know, again, this is kind of anything in life. Leadership does matter. You're right. You know, the talent matters a ton, but how do you sniff out the long ones? You can feel the machine going too. Right. And you can see these organizations. We've been fortunate to work with an organization that has grown tremendously in the last 5 years, and how you can tell they're a winner because they are quick to adopt change, really quick, and adopt, like, how do they systematize things that they wouldn't have done 2 years ago because they're now a more mature organization. And from talent leadership perspective, you're always looking for, at least I'm looking for people that are surrounding themselves with great people. Like, you can't have, like, every single person you hire has to be somebody that's awesome. Yeah. And has the opportunity to grow and, you know, and really make a difference in the organization. So, you know, if you see people that aren't doing that, right, you know, that aren't spending the time, you know, the talent development. And I mean, I'm sure you guys hear it all the time too. Every day is a war for talent, and, you know, where can you get it? And it's one of the reasons why, you know, we still spend a fair amount of time teaching. You know, my partners go in the classroom every year, and we get first look at 35 kids every year who we think are pretty darn special. Yeah, and it gives us it's a unique advantage to have, because we have put those students in our portfolio companies. We've put them with partners that we invest with, that we co-invest with. We have, you know, introduced them to people who we think are really good investors and really good people. And it's a huge advantage. So, like, we're always thinking about talent, and most of our companies are always thinking about talent, and most investors are always thinking about talent. Like, that's not going away. AI is not replacing that piece. Yeah, it's replacing a lot. But
you know, when you pivoted into talking about talent right there, it made me think of my kids, not in the sense that they're talented, which they are in their gifted ways, but like in attracting a great spouse. And I think the answer is the same, but did you hear Mom and Dad talk about this when we were kids?
Probably.
Or did I pick this up in college maybe? But I remember the phrase, if you want to attract a queen, you need to be a king.
I did not hear them say that, no.
Okay. Yeah. So maybe I picked that up in college. But for you guys to be able to attract great talent, you guys have to be a great company, you know, like worthy of the talent. That's often what I think of, is like, man, if I need to attract better talent here, I need to make sure that we've got a company here that's worthy of great talent, you know.
And you got to believe it.
Attractional, you know, there.
Yeah.
But
I think that's well said. I mean, I think in being attracted in lots of, I mean, I tell my kids that about just working, like their professions that they choose. Any of these young people, I always say, don't worry about, like, A, don't worry about a title. B, don't come to me and tell me that you're thinking about leaving for $5,000 or whatever. I don't care what, like, that's not what's important. Are you given the opportunity to grow? Are you given the opportunity to learn? And are you going to make the most out of that? Like you talked on one of your episodes earlier about, you know, making sure that you're maximizing the God-given skills that you had. Like, that's it. Because if you do those things, everything else will take care of itself. Right. Everything else. I've never once asked for a job, you know, a new job in my life. Never once. And I'm a firm believer that just keep your head down and not be ignorant of things going on. But if you're excellent, companies that are worthy of you will find you.
Yeah. Yep.
And you know, if you want to get better, we work a lot, like as Sator Grove, like we're together a lot, and we're on the phone a lot, and we're on email a lot. It almost never feels like work.
Yeah.
Like we're always helping each other. We're always thinking about how we can grow, how we can help a founder, how we can help an investor, how can we help, others. And
it sounds so nice to be able to just to be in that position to see somebody that needs help.
Yeah.
Right. And to be able to do that. And so there's helping them financially. Mm-hmm. And then how much of what you all do goes to help them make better decisions in running their company?
I'd say a lot.
A lot.
So our typical is, and this would be different than the commercial real estate world for sure. When we're thinking about, if you look at just your bread and butter private equity firm, which we're not even close, they would typically take a majority position of a company that they're investing in, or all of it. Like they would rarely have a minority position. Like they're not going to buy 20% of a company. They're going to buy 100% of the company or 80% of the company. Sometimes, rarely, 60% of the company. They want to control it. We don't care about control, right? We think that because we're not operators. And then that private equity firm, once they buy 100%, they're going to bring in an operating partner that has a deep skill set in operating. Great, works out, and sometimes it works out, sometimes it doesn't. We're not operators, right? Like I think, Timmy, that a huge part of the value that we bring to the table is just that. We have totally different backgrounds. The three of us do. Yet we're on the same page in almost everything. We often debate, we rarely disagree where we come out. And but we come at things from totally different angles. And I think that's a value add to our founders, or frankly, even people that we're not. I mean, we spend a lot of time just working in the ecosystem. And part of it is, you said it on one of your episodes, and you're not going to answer for your sins, but you need to answer for what you do with your skill, right? And your God-given ability. And that's some of it, is that like and I struggle with this personally sometimes. Like it's one of those things, a skill set I've been given is being a problem solver. I don't always like to do it. I really like to build, but I don't always like to problem solve, right? But I think it's a skill set that I've been given. And if someone is asking me to help them solve a problem, like I'm torn sometimes. And sometimes I have to force myself to do it because I'm like, I need to do this. This is the right thing to do, right? And we play that role. And by the way, we do it for our investors too, our shareholders. We're like a family and friends office. You hear about family offices, right?
Yeah.
We're family office, and we're family and friends office kind of is really how you probably would describe us the best. And we hope to be, just like we lean on our shareholders that have a particular expertise or know-how, or they might know somebody and we'll say, hey, we're thinking about this. What do you think about that? They do the same to us, right? And we're not partners. We throw around the term partners all the time and partnership all the time. And, if it's a one-way street, that's not a partnership, right? And so we take it very seriously that we don't have a formal board. We don't have an advisory board. It's just the three of us. But how we kind of think about it from all of our shareholders is they all have a voice. We'll talk to them at any time. And we do. We spend a lot of time talking to people that are invested with us. So I'd say probably that's the predominance of our time is spending with those companies. And sometimes it's just like people things. Like, this is a situation, not, hey, should we go buy this asset? Or, I think I can get this software company for 2 times EBITDA and I can sell it for 5. And they're not asking us those questions generally. They're asking us like, I got this situation and this owner that I'm talking to, like, this is kind of how he's posturing. What do you think? Well, what's that? What would you think that person's going through in that person's head? It could be something like that. Or you see, like in any industry, and it's not dissimilar. We spend a lot of time in vertical market software. So software companies that, apply to a very niche type of a company. Like in Europe, there is a vertical market software company that serves basically orchestras. And that deals with.
I did not think you were about to say orchestras.
So they have. Talk about a vertical, really niche things. as opposed to something that would be horizontal software like Microsoft.
Sure. Gotcha. Yeah.
Anybody could, any industry, any person, any, whatever. You're starting to see a little bit more consolidation in those areas. So we might talk about that. I use my M&A background. Both of my partners have, I would say, deep research capabilities. They're both students, of history and spend a lot of time talking about it and are able to use that knowledge that they've accumulated over years and years and years through many different experiences and apply it to current day situations, which is pretty cool. And kind of what you said, Bo, that you got to be worthy of that. And hopefully we can complement some of our founders that when we know maybe where their gaps are. And so maybe we're a little bit more forceful with, hey, I can help with this if you want to. Typically we don't. Typically we kind of sit back and let them
here if you need us kind of thing.
Yeah. I mean, it's again, my background in problem solving, when we have some problems or some conflict or something, that I usually get involved. Not because I want to, but it's the role that I play in our partnership, which is fine.
You hate it. You hate it.
I don't.
The vein in your forehead is giving us a clue.
I don't like doing it, but I do think I can get the outcomes.
Yeah.
So I like the outcome. It's the right thing to. Way better for me to spend my time on it.
Yeah.
Than one of my other partners who have skill sets that I could never have. Right. And and maybe higher value of their time too. So I think we ding and dong pretty well, but I don't always love it now.
Sure. Who likes a problem, right? Who likes a problem?
Well, and then when I worked for a manufacturing company, like almost everything I did we're solving problems. Heavy conflict with customer, conflict with a different manufacturer or supplier, conflict with internal, all over the place. So that wasn't that, that wasn't that fun, but I learned a lot.
You mentioned earlier about who your investors are. And I think you shared with us at Capital Camp, there's basically maybe 1 degree of separation. Like these are either people you really know and like, or somebody you know and like is vouching for somebody. Like maybe 1 degree of separate. Talk about, like, because look, there's a lot of funds out there. You got a big idea, whatever their mission happens to be, they're motivated to get this thing off the ground, and what they need is capital.
Yeah.
And so it's really hard to say no when somebody's ready to write you a check. But you guys say no. Like, how does that
There are some
play
people
out?
that are, I mean, probably shouldn't use this, but that some people that are actually people we've known for a long time that we never even told we were doing this because we didn't really want them to invest. And they're perplexed by that, right? Which kind of tells you they probably weren't the right people for us anyway. The good news is when we started, we didn't, like when those guys first put shovel in the ground, they didn't know if they were going to raise $1 or a bill. They had no idea. So they thought, well, we'll see how it goes, right? And then they got some traction, and then in the markets, and that happened to be, so that was in 2021 at the end, trail or beginning of 2021. So you're still got a pretty frothy market at the time. It was a pretty good time to be fundraising, and that was our first raise. And then we went into 2022 and the market had flipped a bit. So a tougher time to be raising in 2022. And to make matters worse, going back to our, you got to show a little bit of a track record. And we got a little bit of a pass because we hadn't been around for but a year. But the problem was that year was not a good year for returns. So not great, but 2022, we were still able to raise our money. And then we've only taken capital from a handful of people since then that were already shareholders of ours that wanted to put more money in from day one. And we just said, pump the brakes. So even those that we did allow in, we wouldn't let them. Some of them we didn't. They just want to put too much money in. We didn't want that necessarily. We like having believe it or not, a scarcity of capital, because it makes us be really, really thoughtful and sharp on how we deploy that capital.
That makes sense.
And some of it is like, if you buy what I'm selling on the compounding, the long-term compounding is where we need to be. Not everything, like it's harder to compound a huge amount of money over a long period of time. and as opposed to like a little bit more nimble amount.
Yeah.
But scarcity of capital really, really keeps us honest in terms of what are great opportunities and not, and having to harvest maybe some of the ones that aren't going to be, your winners.
We had this conversation with our previous guest, Garrett, on how difficult it is. We were talking in terms of family offices, but you get to the point where you've made all this money, and then to put that to work well can be very, very difficult.
Very hard.
Yeah.
It's kind of like a 1031 exchange in commercial real estate where you've decided I'm not going to pay the tax. And so you sell, and that money goes into a qualified intermediary, and then you have this timeline you have to hit, and you're forced
Time to get another Walgreens.
to buy something else.
Yeah.
And you might have to buy something you don't love.
Right.
But it's better maybe than having to pay that tax that you would have. And so, in a world of as big, as fast as possible, like that's a very rare take.
Yeah.
Like you don't hear fund guys talking about.
And the other thing that I didn't mention, which I probably should have started with that, remember how we're incentivized. Like if we raised 100 million or $1 billion, we got paid the same thing. Doesn't matter.
Right.
So my incentives are really aligned with the long-term optimization of our investment vehicle. If I'm incentivized by getting a percentage of what I raise, of course I'm going to take that money.
Yeah.
It's really important to us that we have, I say it's a close second. So first of all, the first thing we're looking for when we're making an investment, we're judging the leadership, right? And we really don't care what the battlefield is, right? There's some that are more attractive to us than others, but if we got the right leaders, the right talent in place, like we're in, even if the battlefield doesn't look great. I'd rather have a great leader in an okay battlefield than a just okay leader in a great battlefield. I want the talent, especially if we're playing the long-term game. That's number one. Number two, I told you we only take down, like our sweet spot is 20 to 25% of a company. We don't really want to take more, and we don't really want to take less because it's got to be enough for us to spend time on, but we don't want to be too much that we're operators, right? So if we're 20 to 25%, just the simple math is, so somebody else has got to be 80 to 75%, right? And we really pay attention to who else is around the table. And that's a big deal because of the incentives. Like how are they incentivized? Are they incentivized similarly to us, right? That they want to compound their capital over a long period of time, or are they going to be flipping out 3 to 5 years? Well, we can't do that, right? So that's the other little nuance. Number one, we're not incentivized to take more money, which most people are, right? And that creates, like, in what area of the world, the economy, does that create a good thing? I mean, generally, when people are only incentivized by money, bad, not the highest value, right? To society, to community, to people, to families, whatever, like you name it. It usually doesn't work that way. But those other people, if they're incentivized differently than us, like, it's harder for us maybe to deploy a huge amount of capital because I can't always find the right people to be around the table with me. So your 1031 issue is kind of our issue with, do we get a little bit lax on who else we let around the table? And sometimes it's up to us. Sometimes we're the ones bringing capital around the table to form a company. Sometimes we're asked to join people. So it works both ways.
So if you guys are sitting there and you run across, and I'm just going to say unicorn, not the $1 billion version of unicorn, but it's the leader that you're like, holy moly.
Yep, and we have. Yep.
But you have a scarce capital situation. Is that when you might open it up and say, look, okay.
Yep. Yep. And in that situation, generally, when we started out, you're right, Bo, on our shareholder side, I'd say about 2/3 of our shareholders, one of the three of us knew personally before. And I would say on average, we knew that person for 10 plus years. The other third were 1 degree separation, right? Or we had met them just a year ago, something like that. So there's a pretty close connection. When we launched, our first investments were made with people, the founders that we have known for a long time. And we loved when we were used to be able to say, we've known these people for at least a couple of years. Like our biggest position is somebody that one of my partners is known for 15 years. one of our other largest position is one of my partner's best friends, the founders. So deep knowledge of those that we're investing into. And then it all changed when our ecosystem, like this is not that big of a world, the permanent, like going back to, is not that big of a permanent capital world. And then all of a sudden, when people understand who we are and some of the advantages that we can bring, we had a lot of inbound. Like we're not generally looking for other investments, but stuff just comes to you. And sometimes it's a unicorn. And there have been a couple. Recently, and then when they come across you, we're just fighting and clawing to get as much as that as we can.
Yeah.
Like I say, our sweet spot might be 25%. I mean, there's some of them, if we could have gotten 70%, we would have taken people that we just think this is the person.
And it's mainly the person.
Mainly the person.
Yeah. Like, were some of them, like, do you ever find a founder that's like just starting, is not really turning a profit yet, but you can tell?
We don't do that as much.
Gotcha.
That would be the venture world, right?
Yeah, okay.
Or even pre-venture world that we don't do a lot of venture stuff that, is like backing a particular company that is just starting out. Think of it more of, even though when I say we're forming a company, you're right. It's a brand new company, so it has zero track record.
Yeah.
But these are people that are spinning out of other companies, right? An example might be in the vertical market software world, the very niche, stuff. There's one 800-pound gorilla in the public marketplace, and it's called Constellation Software. And they own, 800 some software companies, maybe more, billions of dollars, huge market cap.
They do a lot of like the blue collar service companies.
Oh, they could. I mean, they do anything. They do like they're so big they have pieces of everything. If you owned a small, like the software company, Mom and Pop in Murray that you're talking about, I bet you anything Constellation Software has called on them to ask them to buy them. Like that's how big Constellation Software. They're super impressive. This guy Mark Leonard is like the father of the VMS roll-up strategy, which is what Constellation Software is. He just stepped down last year, but amazing run as CEO, and I assume he's a majority shareholder. I don't know that off the top of my head, but just amazing work. They have they're a machine, huge machine, and they have all kinds of like uber talented people that go through there to work. We might pick off two people that were on, one of his teams, and then pull them out of there, get some other investors around them, capitalize them, give them some money to start, and then we all make commitments to them that over time they can draw down those commitments as they find other companies to buy. But they're basically doing what they learned how to do there. So they already have a track record.
Yeah,
right?
Gotcha.
Or there's something about them that is niche. Like one unicorn that we found, he's in a marketplace that has almost no competition. Like he's an amazing young man. He's gonna do amazingly well. So there's a couple like that. But yeah, that long answer, Bo, that would be a reason that we would go back out, because again, we don't want to sell out of something prematurely to be able to fund that. Mm-hmm. And I have that scarcity mindset that just in terms of capital, we actually don't have we're the opposite of having a scarcity mindset. Like everything to us can be a win-win. Like we're never trying to take more than our share.
Sure.
We don't think
well, you're forced to be lean and wise.
Lean. Very, very lean.
Yeah.
Very, very lean.
It's
everything
like
we do.
Profit first accounting for investing.
Right.
I'm just going to take small portion size, and I'm forced to make decisions based on a small portion size.
Yeah.
Yeah.
And
and I don't know that we won't ever become operators, right? But that's not our skill set. Timmy, we did, we've had a couple of investments in that were more venture like. One didn't go so well, so that kind of soured us a bit.
Yep.
It's just not what we do, I mean, that's a particular, like Sequoia knows how to do that really, really well, right? It's just not our skill set as much.
So this chia seed pouch idea I have.
Listen, I think it's amazing. And if I were a venture investor, I would write you a check right now. But I'm not. So
thank you. No, fair enough. Fair enough.
When you call me in 10 years after this blows up.
And
you need to go to the next level.
I see. Okay. Yeah. I am a squeaky wheel. So
that's good. That's good. Thank God for caller ID. Some technology is worth its weight in gold.
Yeah. All right, cool.
Man, we probably need to.
Your brother here, he can be your funder for this amazing idea. Like, who knows you better than him? Come on.
That's right. That's right.
Time to wrap this up, I think. It is time to wrap this up. I'm going to go dig a car out of a driveway.
Oh, yeah, that's right. That's right.
Well, this has been fascinating. I feel like I've got 2 more hours of questions, but we do need to land the plane here. And
if there's one thing that you could say to a founder, let's say one thing you'd say to a founder before they sign that paper, what would you have? What phrase would you have them tattoo on their forearm?
It's a great question. You brought that up in the intro too. Is like, what should they know? And I don't know that I have a phrase. I'm probably not that quick to think of something, but it's super important for them, right? If it's their life's work, they got to make sure that they have people around them that are incentivized that will enable them to perform their life's work. And that's a hard thing to do. I mean, to your point about an investment firm needing capital, and hard to say no, even harder if you're a founder.
Oh yeah.
You know, and trying to get money. So it's really, that's a really tough thing, especially if you're a venture, you're a Chia company. It's going to be hard to turn down capital, right? Because you don't know when the next one's going to come around. But I would also say be a student of history. Like there is, I mean, what you guys are doing is like, we are nutso, the three of us, my partners and I, about podcasts. Like, it's like our nonstop, hobby basically. And what you guys are doing is just allowing people to learn simply.
Oh,
no.
Like we're learning.
Well, that's
us.
Well, that's the secret.
And there happens to be an audience,
that's
but
the
like
secret.
we get to learn.
That's the secret to it, is that you guys are learning it. And it's the same thing for my partners. When they're on air, it's the same thing. We're interviewing people that we want to learn from, right? It's an amazing thing. Our friend Patrick O'Shaughnessy, who has a very successful podcast, and Best Like the Best, and his company Colossus, he says it often that podcasts are to the spoken word what the Gutenberg press was to the written word, right? And that we're just democratizing all of this. It's why we started our podcast at the urging of Patrick. And to a founder, I would talk to them about being a student of history. I mean, there's, I don't know if you guys listen to Founders. It's actually called Founders, David Senra's podcast.
Yeah, and I listen to him on your all's podcast.
He's been hugely helpful to us and a friend of Sator Grove, and he was actually one of the first that we did in the classroom. He was the second one in the classroom, and he's taught on campus for the guys a number of times. But he has amazing lessons for founders, amazing, and they're all out there. I talked to my daughter about, if you want to get better, like, she's actually interested in commercial real estate. Like, well, if you want to, and she's an accountant, if you want to learn about it, like, you've got no excuse, because there is so much content out there that is good that you can learn from. But like those founders, we will tell them, we'll tell them some of our episodes, like, here's some episodes, but here's some of David Senra's episodes that are exceptional. You listen to the Acquired guys. Oh yeah. Like they're like, some of their stories, go read Phil Knight's book, The Shoe Dogs. Like, that's, you will learn more from those books than you would learn taking an entrepreneurship course and at whatever. Right. You name the fancy business school, right? There's so much out there.
It's for anything you want to learn.
Absolutely.
Yeah. Anything.
Right. Absolutely.
I mean,
absolutely.
I wanted to build a work table, or like a workbench.
Yeah.
And I've never built anything in my life.
Yeah.
And I found a YouTube video and just did what they told me.
Right.
And it worked.
Yeah.
And I was like, I can't believe
it. Yeah.
This way, but you can learn anything.
Yeah. Anything.
On podcasts and YouTube, and
some founders, like, you might know, they'll tell you, I don't know how to do this, or I'm not an acquisitions guy, or I'm not an accountant, whatever. And you'll say, oh, well, maybe go focus on this, and maybe you have a podcast for them. But it's so easy. And it's also a really easy way to screen people. I don't know if you guys do that at all. like people that want to come in and talk to you. Like if your insurance guy would have come, you could have sent them like 10 different videos and see if he actually listens to them.
Oh yeah.
Like people will self-select out of things. There's a really, really wealthy guy that, very different guy, but very generous, who taught me once. And I had a little bit odd relationship with this, and his son had a lot of money too, because the dad made a lot of money. And he used to tell his son, anybody that calls you and asks you for money, tell them two things. Okay, follow up with a written proposal to me, send me a video of you like pitching this, whatever, and then write me a letter of why my interaction with your non-for-profit is value add for me. And he says 95% of people never follow up.
Yeah.
And he said, if people did just that, I'd give them something. I may not give them what they're asking for, but I'd give them something. But 95% of people wouldn't even do it.
Wow.
So if it's a founder that we might not know or still trying to get to know, right? Maybe we say that and say, come back in, a couple months and come talk to me. See what they do.
Have you seen the movie Draft Day?
Oh yeah,
Kevin, I love that movie. Have you seen it?
No, Draft Day?
Yeah, it's Kevin Costner's sports movie.
Oh, okay.
He's got one for every sport, basically. Okay. But this is the football movie, and it's really good. But there's a story about the teams. It's Draft Day. They're interviewing potential players they might draft. And so the top ones, they'll send them the playbook, and they put $100 bill in it to see if they actually read the playbook.
Yeah, yeah.
And it was that kind of just something that helps you screen or figure out real quick if they're putting the work in.
Totally.
Right.
Are they committed?
Yeah.
Right.
Are they committed?
That's right.
I mean, it's like all of us, we want to be around people that are committed and have great values. And
that's right. That's right. If there's something that I learned from this, it's incentive, right? Like that's what I would, with everything you talked about, that's what I would put on the tattoo I'd put on my forearm. History, incentive.
That's a pretty good one, actually, Timmy. That's pretty astute.
That's pretty good.
It's really good.
Hey, see, that's pretty good.
Now you need to send him a video.
That's really good.
When you've done it.
Oh yeah,
and then maybe he'll come back on.
but that is good. I mean, that's what we talk about, and it's what attracts. I have had a ridiculous amount of investors say, "I didn't really read any of your stuff. Once I figured out what your incentives were, I'm comfortable. I trust you. You're going to do the right thing because you're incentivized to do the right thing."
Right.
And then, we talk about our founders all the time that if you got the right people around the table and we got the right incentives in place on the structure, we got a lot better chance of success than otherwise. Mm-hmm. So that incentive's a good one, Timmy.
Yeah. Okay, good.
This guy was listening.
Oh,
I'm not sure about you, but he was listening.
I'll tell you. I don't have the headphones on. But that has been a big takeaway of doing this podcast. We're going on 3 years. And next month, it'll be 3 years.
That's crazy.
And
congratulations, by the way. That's pretty cool.
Thank you.
Thank you. But I have been amazed at how well you listen, what you retain. He's a much better interviewer than I had anticipated. I didn't know, insightful question. It's a lot of fun to do this with your brother.
Low expectations are great, aren't they?
They're so great. They're so great.
I had high expectations about the energy level we were going to have on our podcast and the amount of fun we were going to have.
Yeah.
I didn't realize how much you'd add on
present
just
company
pulling
excluded.
Great. Yeah. But anyway.
Well, thanks, bro.
You guys, it was not lost on me that we're still in January, so you guys are taking dry January to a whole new level, having a dry guest on right now. So I applaud you for living with mainstream media.
Man, I'm telling you, this has been a fascinating conversation.
Yeah.
Oh, well, I appreciate you guys having me.
You're a perspective we haven't really had on the podcast.
It's great.
It's been
I've been inspired by the conversation that we had back in November and what you guys want to do, because there's so much value, there's so much more value that you can add, not only to your own lives, to your point, Timmy, like how you're doing things, but to your investors and then to the ultimate users of your amazing, work. So I think if people can tweak just a bit, right? I mean, the guy, I listened to your guy that I'm not good with names, is the name that you guys butchered. who wants to do the culture.
Austin
Tunnell.
Austin
Yeah, I
Tunnel.
mean,
Yeah,
he's
Tunnel.
trying to change.
Tunnel.
He's trying to change culture, and like a lot of what he talked about resonated really deeply with me because
The built environment.
it's kind of the same thing that we go through.
Yeah.
Right? There's a lot of people like, wait a minute.
Oh yeah.
Even some of our service providers. This is crazy. Like some of our service providers who are these massive, well-known names. Like there might be like big public accounting firms or fund administrators or whatever, and they'll ask me, well, what bucket should we put you in? It's like, we're not a bucket place. Like we're not one thing. Well, you have to fit within the private equity accounting group or the private equity this or the venture capitalist. Like, well, you can put us there, but that's not what we are. And then inevitably, like 6 months later, like, well, why are you doing it this way? Private equity firms don't do that. I know, we're not a private equity firm. That's what I told you. Right, exactly. We do not do it that way. So, I mean, we don't fit neatly anywhere, which can be good and bad. It gives me zero pricing leverage, of course.
That's right.
But it's good and bad. So it's about changing culture, and what you're trying to do with the founders. The number 3 is it's inspiring too.
Yeah.
I love it.
Well, I'm glad.
Yeah.
It's exciting.
I love it.
I love it. I love it too. I love it. I love it. I do. I'm getting like, this is one of those
getting fired
conversations-
up.
It's one of those conversations that fires you up. You're looking, it's just inspiring to look at something differently, and get out of that little rat race of the circle of that's just the way it is.
Yeah.
Yeah.
We just
Fuck
have
off,
to, we just all have to fundraise. We just all have to sell things. We just all have to distribute. We just all have no question about it. Yeah.
Yeah.
It's nice not to be on that rat race
That's right.
for sure.
Thank you so much for coming in.
man.
No, thank you guys.
Yeah.
It's been fun.
Yeah.
Such a pleasure to have you
lot of
in
fun.
the vault.
I
In the
love
vault.
being in the Big O. I get to
right.
see my boy Mike Edge.
Oh yeah, that's right. That's awesome. That's awesome.
That was Greg Dugard. Raising billions and building businesses that last longer than most people's attention spans.
Well, yes, and he builds trust the way most people build IKEA furniture, except he doesn't wobble and no one ends up crying.
So if you're a founder, an investor, or someone who just wants to understand the game behind the game, rewind this episode and take notes.
And while you're at it, please do all the things podcasts beg you to do. If you're listening via Apple Podcasts, leave us a review. We will shout you out and read it on air. Test it. Give us 5 stars and write something like Booger Butt, Tinkle Splash, Pickle Party, Balderdash, and see if I don't get Bo to read it. Just write anything. Put 5 stars. You don't have to put much thought into it. And you can also watch all the full episodes on YouTube or Spotify. Bo had no idea I was about to say that, I think.
Booger Butt Tinkle Splash.
It's a Pickle Party, Balderdash. Oh, yeah. No, let's hear it in your voice real quick.
Booger Butt Tinkle Splash Pickle Party Balderdash.
Isn't that beautiful? Isn't that beautiful? If you want Bo to say anything else, leave us a review. We will shout it out. And look, we are nothing without your clicks, emotionally and financially.
And if you're a founder tired of chaos and ready for growth, go to superpowershq.com/commercially speaking.
Splash.
Did I just say
You just
that?
said splash commercially.
Let me try that again. Go to superpowershq.com/commercially speaking. Oh, and get yourself an executive assistant who will change your life like Alice has changed mine. And don't forget to subscribe to our newsletter at subscribe.wgbarron.com.
And Barbara Corcoran, if you're listening, you are the whisper in my chia pouch. You are the permanent in our capital, and you are the med school we never needed.
All right, let's wrap it.
And your invite to be our guest remains open. Call me Barbara. Let's build something irrational together.
See you next Tuesday.
Love you, brother.
Love you, man.
Bye, Alice.
Bye, Alice.
Bye, Bridget.
Bye, Bridget.